I read your notes this morning, Mark. AI CapEx burning through investor cash, but there's a lot of cash. So how much further does this go?
Look, my answer is going to be a little bit boring here, Guy. It's going to be the same as I've said for probably the last sort of year, maybe it's 9 months, I don't know. Next earnings season's always what I'm looking at, and it's going to constantly be the next rolling earnings season. It's not because I think it blows up specifically in the next earnings season. It's because I think the AI CapEx bubble bursts when one of the hyperscalers changes tack on their capital expenditure plans. And I think that can happen outside kind of results season, but I think it's unlikely to. So I think it's most likely we get to earnings, or at least we get a hint in those earnings seasons that, hey, it's not really working, or the revenue's not coming through fast enough to kind of keep up the kind of hope, the pipe dream that we might see the revenue explosion that will justify the CapEx explosion that we're already pricing in. So I kind of always think it's the next earnings season. Do I think my base case is the next earnings season? Not necessarily, but I think you've got to be alert to it. We're already quite far through inflating this AI bubble. It can have plenty more to go. This most recent earnings season shows that it's still going strong for now.
And you've talked about as well, Mark, in your notes about the fact that this additional spending could be marginally negative for Treasuries. We're watching Treasuries, of course, in the lead up to CPI inflation out of the US tomorrow. Is that inflation print backdated to July? Is it less important now, given what we're seeing in terms of higher gas and diesel and oil prices?
Maybe, but I think we keep on dismissing each kind of marginal data print that comes through because we're saying that the situation is so dynamic. I think, though, what is interesting here is the context of Treasuries. I think the pressure on Treasuries is going to be a real theme going into year-end, into midterms. We have fiscal incontinence in the US, which is unlikely to change before the elections. We don't have great policy credibility from various parts of the US arm, whether it's the Fed or the Treasury at the moment. And I think we've got, clearly an inflationary backdrop. We can negotiate or debate about exactly to what extent. But I think the backdrop for Treasuries is very negative, and I think that pressure is going to increase into year-end. The expansion in hyperscaler debt doesn't help that, and it's with that context that we've got US CPI print this week.
I mean, it's an interesting one. We've had a mixed reaction yesterday in assets in terms of oil prices up, but gold is also up, and there's all this optimism around Europe still. Does that need to be put into the context of the risk of higher oil prices and the fact that we started the year with the 1.2% real GDP forecast for 2026?
I think that people are starting to cope with the higher volatility in oil prices and with higher elevated oil prices. Of course, if we see Brent crude spike well above $100 again, that will derail some of the kind of the bullishness around Europe at the moment. But I think that if we're with volatile at this range of $80 to $100, I think European stocks will cope and the European bullish story will sustain.